Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vornado Realty Trust annual report. Vornado Realty Trust offers a diverse range of businesses and services through its extensive portfolio. The company's primary focus is on real estate investment trusts, REITs, encompassing premier New York City office, retail, and multifamily assets. In addition to its core business in New York, Vornado also owns significant properties in Chicago and San Francisco. The company's expertise extends beyond property ownership, as it is also a developer of new projects. The most notable example is the PNN District development, which showcases Vornado's capabilities in creating innovative and sustainable spaces. Furthermore, Vornado has made sustainability a core aspect of its business, with all its in-service office buildings achieving LEED certification. This commitment to environmental responsibility sets Vornado apart as a leader in the real estate industry. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The Vornado Realty Trust stock price has dropped significantly over the past year due to several factors. One major reason is the decline in the commercial real estate market. As the economy slows down, companies are reducing their office space needs, leading to decreased demand for commercial properties. This decrease in demand has resulted in lower rental income and property values for Vornado Realty Trust. Another factor contributing to the drop in stock price is the increasing competition from online retailers. With more consumers shopping online, brick-and-mortar stores are struggling to stay afloat, leading to reduced foot traffic and decreased sales for retail properties owned by Vornado Realty Trust. Additionally, changes in government policies and regulations can also impact the real estate market. For instance, tax reforms or changes in zoning laws can affect property values and rental income, ultimately impacting Vornado Realty Trust's stock price. Lastly, economic uncertainty and market volatility can also cause a drop in stock prices. As investors become more cautious, they tend to sell their shares, leading to a decrease in demand and subsequently lower stock prices for Vornado Realty Trust. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Prepaid lease payments have seen a significant increase, contributing $901,409 to the revenue growth. Additionally, proceeds from sales of real estate and other assets have also increased by $58,339. Furthermore, distributions of income from partially owned entities have risen by $114,754. The company's property management fee income has experienced substantial growth, increasing by $3,538,000 in 2025. Moreover, income from wholly owned subsidiaries for cleaning, security, and engineering services has also seen a notable increase of $4,567,000. On the other hand, revenue decline drivers include net gains on disposition of wholly owned and partially owned assets, which have decreased by $-35,291. Straightlining of rents has also resulted in a decrease of $-71,960. Furthermore, partial redemptions of preferred equity have led to a reduction of $486 million. Other key factors that impact revenue growth or decline include tenant occupancy and rental rates, parking facility operations, trade show booth rentals, management agreements with third parties or partially owned entities, and the collectability of tenant receivables. These factors contribute to the overall revenue growth or decline of the company. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by $917,088 from 2023 to 2024 due to a large decrease in net income compared to operating cash flows. However, this trend was reversed in 2024 when the net income increased by $12,147. Unfortunately, this increase was short-lived as the net income plummeted by $1,159,000 from 2024 to 2025. The profit margins of the company also experienced some changes during this period. The overall profit margin decreased slightly from 61.7% in 2024 to 61.6% in 2025. However, a closer look at the data reveals that there was an increase in profit margins for a specific segment, rising from 64.1% in 2024 to 65.2% in 2025. The reasons behind these changes are multifaceted. Book-to-tax differences primarily contributed to the fluctuations in net income and profit margins. These differences arise from various factors such as depreciation and amortization, gain or loss from sale of real estate, impairment losses, straight-line rent adjustments, stock compensation expense, and repairs expense related to tangible property regulations. In addition to book-to-tax differences, other factors also played a role in the changes in net income and profit margins. Reduced management fees and lower interest income were two significant contributors to this trend. Overall, the fluctuations in net income and profit margins reflect the complexities of the company's financial performance during this period. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, the company recorded a significant increase in net cash provided by operating activities, rising from $537,723,000 in 2024 to $1,258,385,000 in 2025. This substantial growth indicates that the company's operations are generating more than enough cash to cover its expenses and investments. The positive trend suggests that the company is on a stable financial footing, with a strong ability to generate cash from its core business activities. The company's debt level has undergone significant fluctuations over the past year. Initially, the debt level increased due to various refinancings and repayments, with a notable increase of $675 million from the Independence Plaza refinancing. However, this was partially offset by a repayment of $450 million in senior unsecured notes. By December 31, 2025, the total debt stood at $7.2 billion. Despite these changes, the company's interest expenses have shown a mixed trend. Initially, interest expenses may have increased due to volatility in the interest rate environment. However, this was later offset by a decrease in interest expenses of $36,401,000, 9.3%, from 2024 to 2025. The refinancing of loans at lower interest rates also contributed to this decrease. However, there are indications that interest expenses may increase in the future. For instance, the 7th Avenue loan interest rate has increased from SOFR plus 230 to SOFR plus 255 in May 2027, while various mortgage loans have interest rate caps with some rates increasing to 4.97%, SOFR plus 1.22%. These changes suggest that the company's interest expenses may increase significantly in the future. Overall, while the company's debt level has fluctuated over the past year, its interest expenses have shown a mixed trend. However, there are indications that interest expenses may increase in the future due to changes in interest rates and loan terms. Management's outlook for the company appears to be positive, driven by strong operating performance and a focus on long-term leases and asset optimization. The company has reported significant increases in net income and cash provided by operating activities, as well as a substantial decrease in lease liabilities. Management believes that their fees are consistent with market rates, indicating confidence in the company's financial position. The company is also investing in its development pipeline, with several major redevelopment projects underway or planned. These initiatives are expected to drive growth and increase the value of the company's assets over time. While there are potential risks and uncertainties associated with environmental contamination, insurance coverage, and ongoing litigation, management appears to be well-positioned to navigate these challenges. In terms of strategy, the company is prioritizing debt reduction and investing in its development pipeline, while also focusing on long-term leases and asset optimization. This approach suggests that management is committed to creating value for shareholders over the long term, rather than pursuing short-term gains. Overall, the outlook for the company appears to be positive, driven by a combination of strong operating performance, strategic investments, and a focus on long-term growth. The company has a history of paying dividends and buying back shares. According to the extracted summaries, the company has paid dividends in various years, with the most recent being $141,277 in 2025. This is evident from multiple pages, including page 9, 10, 56, 57, and 109. In terms of share buybacks, the company has also been active in this area. The summaries reveal that the company has repurchased shares in various years, with a total of 2,262,360 shares bought back in 2025 alone. This is mentioned on pages 34, 37, and 56. Additionally, the company has an authorized repurchase plan for up to $200 million of common shares, as stated on page 56. Overall, it appears that the company has a consistent track record of returning value to its shareholders through both dividend payments and share buybacks. That concludes the financial summary for Vornado Realty Trust. Feel free to comment below, and I will be happy to answer them when possible.